Investment homes and second homes on jumbo loans have really tightened up. Only a couple of our investors actually even do investment property jumbo loans anymore. They're extremely hard to get. 700, 720 credit scores, 12 months reserves, 20, 25% down, and they're going to run you through the ringer to make sure that you're on the up and up. And a second home, it better really be a second home. No more of the days of, well, I live in North Austin, I'm going to buy a new second home in South Austin. That's just not happening. They're really making sure it's in a resort area, it's 50 miles away from your house. There's got to be a tangible reason that they can prove that it's going to be a second home. And on the jumbo side, you might as well just treat it as an investment because they're just turning them down. The reason they're doing that is that's where they see a lot of their losses. Lenders don't really want to do jumbo loans. If you think about it, if you do a $1 million loan, the bank's putting all their risk into one loan, right? If they can do 5 $200,000 loans across a specific geographic area, they're spreading their risk out a little bit. So that's why they're getting better rates and lower down payments on those other loans. People buying into the jumbo loans, those people are usually highly invested into the stock market. They probably had a lot of losses in their 401ks over the last couple of years. So they're probably a little bit timid when it comes to making another big purchase like that. A lot of people are scaling back. So jumbo loans, there's just not as much demand for them anymore. Talked about the rental rates, debt to income ratio. That's going to be a big topic of conversation today. And so when you're looking for your buyers to market to here over the next 12 months, you've got to understand that a lot of them that qualified today don't qualify after December 12th. And December 12th is a big day, and I'm going to tell you what that is here in just a few minutes. But on a jumbo loan, a lot of the investors are 41% back-in ratio or 45% back-in ratio. 41% back-in ratio is very low. No more stated income, no more stated asset, no ratio loans. You've got to have verifiable income. 2 years on a tax return, can't be declining. I can't tell you how many credit reports, how many tax returns that I've looked at over the last 6 to 12 months. And Jason, I mean, you and I see them all the time, where somebody is self-employed. They had a great 2007, but 2008 they had declining income, about 20%, but they still make plenty of income. Guess how we look at that? Can't take it. We can't do the loan because they had declining income. We go over 20%, they're going to think it's probably going to decline the next year too, but everybody's had a rough 2008. Doesn't matter. They're still not going to do it. By the way, I know I'm being depressing right now, but I will bring this up here in just a few minutes. Months of inventory in these areas are very high, 10 to 20 months worth of inventory all around Central Texas when it comes to jumbo loans. Just a lot of inventory out there, not a lot of demand for it. What does that buyer pool look like? Well, that buyer pool is really, that looks like a house down in central East Austin. That pool, you can tell, is probably about 8 feet across. Very small buyer pool out there for jumbo loans. My advice to you, and y'all can take it or leave it, though, if you're going to be spending your marketing dollars and your time and your effort to go out there to try to find buyers and listings, you may not want to do it in the jumbo range right now. Not now, but as we're going to see later, maybe at the end of the year might be a good time to go out and start marketing those. But right now, the jumbo loans are not going to come back until jobs come back, because there's no incentive out there the federal government can give you. Because remember, $8,000 on $100,000 is 8%. $8,000 on $1 million is nothing. So there's not a lot of incentives the government can do right now to get people to buy jumbo loans or get the banks to lend easier on them. That demand is very, very low, and it's going to continue to be low until we add jobs. So let's talk about conventional loans. Fannie Mae, Freddie Mac. There used to be more conventional loans than that, but that's all we've got now. Fannie Mae and Freddie Mac. Anything up to a purchase price of $439,000, $440,000. 5% down, get you $417,000, just like we talked about a few minutes ago. 620 credit score on conventional loans with Fannie Mae now. 620 credit score. There's a caveat to that, though. If you're putting less than 20% down on a conventional loan, you have to have mortgage insurance. Forget about second liens nowadays. Unless you're perfect and squeaky clean, you're not getting a second lien. If you have less than a 680 credit score and you're putting less than 20% down, you cannot use a conventional loan, because you can't get mortgage insurance for it. It's impossible. They won't allow it below 680. So what does that mean? Well, that means somebody who's buying a $350,000 house, who's got 5% to put down, it has a 675 credit score, can't buy with a conventional loan. It means he has to use FHA. Well, FHA loan limits are at $288,750. That means he's going to have to put $62,000 down on that $350,000 house, but he's only got 5% down. So what's he going to do instead if he wants to buy? He's going to look at his lower price range, right? Downward price pressure once again. That's why you're seeing a lot of these houses bought below $300,000 because that buyer pool is so large. So 680 credit score, if it's less than that, you have to put 20% down because you can't get the mortgage insurance. PMI is just not available above with a DTI, debt to income ratio, above a 41 also. So not only do the private mortgage insurance companies have a 680 credit score requirement, but you also can't have a 41 backing ratio or higher and get mortgage insurance. We do have one company out there that if you're a squeaky clean borrower, they'll go up to 45. I think it's PMI, right? They still doing it? You have to be really squeaky clean. So let me give you an example. If I'm putting 15% down and I have an 820 credit score, full documentation across the board, I can't get a loan if I have a 43, 44 back-in ratio. And to give you an idea, I ran some numbers. Over the last 2 years, about 25% of our business had higher than that kind of ratio. 25% of the business out there that can't get that loan now in that price range. We're going to show you how you can get it in a lower price range. And these are all things that are keeping prices low. Okay, conventional loans. This one right here is a big one, guys. As of December 12th, this number right here, debt to income ratio on a conventional loan with 20% down, used to be 64.99%. Guess what it changes to next week? 45. From 64.99 down to 45 back-in ratio. A lot less people can qualify for a conventional loan. Remember, this is conventional, not FHA. Conventional loans, the Fed's been buying mortgage-backed securities to drive interest rates down, right? It's going to expire first quarter of next year. That's a good thing. Second homes and investment properties all require 20% down on conventional loans right now. And if you're buying an investment property or second home, you can't have more than 4 properties financed either. So the days of having 10 properties or whatever are out for now. Fannie Mae and Freddie Mac allow it. None of the investors allow it though. 4 properties financed is the maximum you can do. Most of these buyers were moderately invested in the stock market, so it just depends. Rental rates are typically not comparable to new mortgage payment. Remember, across the board, it's full documentation loans now. There are no, like I said before, no stated income, no ratio loans. Everything is full documentation. They really look at it. It's not anymore with 1 year's tax returns, it's 2 years tax returns. They want a current year-to-date P&L from the person. The person can just type it up on their typewriter, but they really are going back to old school underwriting with Fannie Mae. Months of inventory in some of these areas are between 5 and 10 months, 6 and 10 months. Better than the jumbo, but still high, still considered a buyer's market in those areas. HVCC. Who's not heard of it? Who has heard of HVCC? Who's had to deal with it? Oh, every day. HVC is Home Valuation Code of Conduct. It's something Fannie Mae put out last May that says that anybody involved in the origination process of the loan cannot speak with the appraiser or order the appraisal or set the expectations of the appraisal or hold the appraiser accountable. So we have to go through third-party companies now. And if you've dealt with this, you understand that the loan officers' hands are tied. We can't even pick who the appraiser is. At the beginning, it was really bad. We were seeing where the third-party company would order an appraisal in Georgetown, and they'd have to go grab out of their hat, and they'd have to do it in a round-robin system, so they didn't even get to choose. They'd have to grab out of their hat, and sometimes that appraiser coming out of that hat to go do that appraisal was from Buda, who had no clue what Georgetown was about. And you couldn't explain it to him, because you couldn't talk to him. You couldn't explain it to the third-party person because they probably didn't understand. So we're having a lot of problems with appraisals. One of the major areas around town that I've been seeing problems with appraisals is Lakeway. Anybody had problems with Lakeway lately? Getting appraisals to come in? There's maybe the values, maybe the people are dropping their prices now, but most of the appraisals we see now, there's a box in there that the appraisers check. It says declining values and oversupplied. Whenever that's checked on an appraisal, we have to drop the minimum LTV requirements by 5% with Fannie Mae and Freddie Mac. So right now, Fannie Mae and Freddie Mac are at 5% down. If it's in a declining market, we have to drop the LTV by 5% before they'll do the loan. So